All right, let's talk McGrath RentCorp. Today we're digging into their Q2 2025 earnings call from July 24th. And folks, the market's reaction was, well, let's just say it turned some heads.
So first things first, let's just look at what the market had to say, because really the price action tells you a lot right off the bat. Boom! The very next day, July 25th, the stock, ticker MGRC, just shot up over 7%. We're talking a close of $124.50, and get this, on more than double its usual trading volume. So yeah, it's safe to say Wall Street was paying attention and they were impressed. So that really begs the question, right? What was in that earnings call? What did management say that got investors so fired up? Well, for starters, it all begins with the numbers. And this wasn't just a little beat, a penny here or there. No, this was a straight-up, decisive outperformance. I mean, just look at the scale of this thing. They didn't just squeak by the consensus estimates, they absolutely crushed them. Earnings per share, a nearly 20% beat. Revenue, they brought in almost $15 million more than expected. That is the kind of number that makes everyone sit up and take notice. But here's the thing, that big revenue number, it's really just the tip of the iceberg. To get the full picture of what's going on at McGrath, you've got to peel back the layers and look at the individual business segments. And that's where the story gets really interesting. Okay, let's start with portable storage. Now, at first glance, you might see that year-over-year rental revenue is down 5% and think, that's not great. But here's the key detail. Sequentially, from Q1, it was up 5%. That's a huge sign of stabilization. And you can bet management was all over that on the call, pointing to those encouraging shipment trends. And then you've got the TRS-RenTelco segment, the folks who rent out test equipment. Man, this part of the business was absolutely on fire. Utilization, which is just a fancy way of saying how much of their gear is actually out there making money, jumped from 56.5% all the way up to almost 65%. Management's not calling this a fluke either, they're calling it a sustainable rebound. So you see results like this, and you know it's not just luck, right? This is the payoff from a very specific, very disciplined game plan. Let's break down their playbook. It really comes down to 4 key things. 1, they're super disciplined with their spending. 2, they're pushing hard to grow their services business. That's where the good margins are. 3, they're hiring salespeople in new cities to expand their reach. And 4, they're making smart, little tuck-in acquisitions. And when I say they're disciplined with their capital, I mean it. Check this out. Year to date, they've only spent $50 million on new rental gear. Last year at this time, it was $145 million. That's a massive pullback. They're basically saying, hey, instead of buying shiny new stuff, let's fix up what we already have and make it last. It's a really smart move in this environment. And this all feeds into what the CEO, Johanna, was hammering home on the call. He said their whole strategy boils down to one thing, being a modular solutions provider. In other words, they don't want to just be the company that drops off a trailer. They want to be the partner that provides the whole solution. He also talked a lot about those tuck-ins I mentioned. Think of these as small, surgical acquisitions. They're not buying massive competitors. Instead, they spent just $22 million this quarter on 2 smaller companies that help them get a foothold in a new city or a new market, like overnight. It's a really efficient way to grow without taking on a ton of risk. So you put it all together, this disciplined execution and some early signs that the market is firming up, and what do you get? You get a management team that feels confident enough to raise their guidance for the year. Now, they didn't go crazy on the revenue forecast, just nudge the bottom end up a little. But look at the adjusted EBITDA. They raised the entire range. That's management telling you we are feeling very good about our ability to turn these sales into actual profit for the rest of the year. But maybe the most important thing wasn't even in the numbers. It was the change in tone. You could just hear it. They used the phrase incrementally more positive. That might sound like corporate speak, but coming off a few quarters of uncertainty, it's a big deal. They're seeing green shoots, like a slight uptick in the Architecture Billings Index, and they're feeling better about things. Okay, so where does that leave us as we look ahead to the next earnings call? Well, it really sets up this fascinating tug-of-war, right? It's McGrath's excellent execution versus a still shaky wider market. So the bull case is pretty simple. McGrath has a winning playbook. Their discipline, their focus on services, it's a formula that can work even if the economy is a little soft. But the bear case is just as straightforward. You can only outperform a bad market for so long. If the overall construction sector stays weak and their competitors are all signaling caution, eventually that headwind could become too strong to ignore.
And that, right there, is the million-dollar question for next quarter. Can McGrath keep being the disciplined outperformer? Can they keep zigging while the rest of the market zags? Or is the gravity of a soft construction market finally going to pull them back down to earth? We'll be watching.
And of course, just a reminder, this is not financial advice.